Welcome back to Money Journey. If you are a long-time viewer of this channel, you know one stock more than any other, Alibaba. This company has been the single biggest position in my portfolio and the topic we have covered relentlessly over the past 3 years, calling it perhaps the best investment opportunity of the entire decade. And finally, that conviction has paid off. Baba stock is up a staggering 124% so far in 2025. That's incredible, but it is the critical question. After such a massive run, is the opportunity over? Is the stock finally running on pure hype? In this deep dive, we are not going to talk about price targets. We are going to talk about value. I'm going to show you exactly why I believe Baba was the decade's best opportunity and, more importantly, whether the massive AI hype surrounding their cloud business is actually justified by the fundamentals. I will pull back the curtain on my own Baba buy history, show you my new fair value after this explosive run, and outline my personal strategy as this is now my single largest position. Am I selling for profits? Should you still be buying? Stick around because if you have ever owned or considered Baba, this is the most important 10 minutes of analysis you'll watch today. Now, let's talk about the elephant in the room and why I believe Baba was the best opportunity of the decade. As value investors, we live for moments when a great company trades at a massive discount. It happens, but here is the normal script. That opportunity is short-lived. Think about any temporary dip. Say, the tariff scare earlier this week, for example. The stock drops hard, smart money piles in, and within a few weeks, the price re-rates back to their fair value. The discount window closed quickly because investors are ready to support the price. But Alibaba, this was different. For 3 brutal years, the price was disconnected from its value. This wasn't a dip, it was an abnormal value opportunity because the geopolitical and regulatory risks were so intense. They scared the entire market away. This created an unprecedented window for you and me. While the price stayed low, you had a multi-year chance to grow your position, which is exactly what I did, making it my biggest holding. But crucially, Alibaba's management took advantage of it too. They executed one of the most aggressive share buybacks program in corporate history at this extreme bargain price. This double whammy of value creation, you building your position and the company shrinking the share count, is why this wasn't just a good opportunity. This was the investment chance of a lifetime. It's a perfect case study in patience and conviction, and it's what created all the shareholder value that is finally being reflected in this year's incredible stock price action. It's extremely hard to find companies, great companies, high quality companies like Alibaba at a huge discount, but yet we did get that opportunity in the past 3 years. I will not talk in depth about their fundamentals because we have plenty of videos talking about Alibaba in this channel, but we'll look at our money journey checklist, which are the best attributes that you should look into a company, and Alibaba is a great one. Revenue growing 23% per year, market potential is huge, especially now with cloud and AI. Analysts are expecting them to grow close to 10% earnings per share per year, but I believe it could be way bigger because the AI opportunity in the world, in China especially, is huge. Quality of their revenues, it's a consumer base in their e-commerce, but cloud is a subscription business, high quality revenues, recurring revenues, so this could be an update in the future as percentage of revenues from cloud gets bigger in the Alibaba group. They have been developing new products, in this case cloud AI products. So they are basically, if you want to invest in China, you could buy Alibaba. They own most of the startups. They have been investing a lot in research and development, and right now they're investing a lot of money in research and development because I believe management believes as well that could yield high returns on investment in the future, and that's why they are investing. They have good margins, especially for the e-commerce business. They have better margins than Amazon, and then they are growing cloud and other business, still very profitable. And right now, returns on invested capital are increasing, so they are recovering from the recession that has been the last few years in the Chinese economy. So all trending higher. If you look to revenues going up, margins and profits still going up and down. Gross margins steadily around 40%, but then we have net free cash flow margins sometimes above 20%. Now it's lower, and it will be lower in the next few years because they're investing a lot of capex in their business. So but net income margins are good, they are very profitable, so that's a really great business that have a very good balance sheet. Bear in mind they have $58 billion in their balance sheet with only $29 billion of debt. The usual in the past they had $80 billion, but they are investing in AI, in cloud, which is something that could yield high returns, and I, as a shareholder, I like and investing in buybacks, especially in the past 2 to 3 years. They are buying back around 3 to 5% of the company, and at that huge discount it was value accretive to shareholders, and I like it. They've been maintaining margins were down because of Chinese economy being in a recession the past 3 years, but I believe they will recover in the next few years, and they are showing signs of that. Margins are better than their competition. They have pricing power, and especially now with cloud, which is a higher margin business, they are captivating a lot of clients, and in the future it will get better and better as a business. That very controlled, really good balance sheet, more cash in short-term investment than their long-term debt, which is great. They're plenty of money to invest in their business, in their future, into buying back, doing buybacks if the price is right. So it's good. Return on invested capital right now is 12%, has been trending higher, which is good. It's a trend we like to see, and I hope this investment yield better returns in the future, but we'll see because there are a lot of risks investing in AI. We'll not know if this will yield high returns on invested capital, for example, but they believe, and if they believe and the management team believe, I believe as well. In terms of management, I think they are very competitive, not the best one, but they show resilience, willing to invest in their business, especially in cloud, which is cloud has been growing 20%. Some analysts, some investors expect cloud to grow above 30% per year in the next quarter, and AI product revenues growing triple digits, which is very good. They show very good capital allocation, buying back shares at really low price. Their culture is very good. In terms of moat, yes, they have plenty of moats. They are a big company like Amazon. They have moats on logistics in the e-commerce. They have the best price. Now they have the biggest cloud, one of the best AI models as well. They are investing a lot in their ecosystem, and their moat, I believe it's increasing. So I'm a really happy shareholder on Alibaba. They've been growing free cash flow around 13% per year, which is good. They've been returning a lot of capital, doing a lot of buybacks. They bought back 3% in 2023, 3.6% in 2024, 5% in 2025. They continue to do a lot of buybacks and paying a dividend. I do not believe they will continue to do a lot of buybacks because of the stock price right now, but they are doing a good dividend as well, and I hope they continue to return capital to the shareholders. So with that, a 70.4 quality score, one of the best, above 70 for really good companies. I like what I see. And my fair value I'm in my discount cash flow for the next 7 years. Since it's a Chinese company, I think there are a medium risk for this business. My discount rate will be minimum 15% for my base case. So assuming 17% margins, 7% growth rate, which is very, I would say I'm taking the low with this growth in AI, cloud. Their e-commerce business, their core business is growing above that rate. The other business will grow fast, so I'm trying to be really conservative here. Only assume a 19 PE. This is high quality. Could assume 20 because of course it's a Chinese company, high risk, but I'm assuming the risk in the discount rate. I'm using a discount rate of 15%, so we are taking a lot of margin of safety and this risk into the discount rate. With this assumption, I came with an intrinsic value of 184.9. Right now, it's trading at $189, close to 190 after being up 120% this year alone. So it's close to my fair value right now, but I'm not selling my Baba position. I understand it's close to fair value, so me as well. I have huge profits. I'm up around 85% in all the shares I own, so it's a huge win for me, especially at it's my biggest position. I have 20+% of my portfolio in this company. Should I be buying more? I'm not buying more because it's already a huge position. I'm not interested to buy more. If I didn't own Alibaba, I'll probably be starting a position because Alibaba potential, Alibaba quality, and close to the fair value. Usually these companies doesn't trade around fair value. It's they always have a premium, and right now I think I have some margin of safety, and my fair value will be around that. So, but right now I'm not selling. I believe in Alibaba for the future. What could make me sell my position or trim if Baba trades at the exuberant price? For example, right now it's trading only at a 16.21 EV to EBITDA, forward P of 90, but if you see like 25, 30 forward P without fundamentals or expectations getting higher, I might start thinking on trimming the position, or if I found better opportunities out there. For now, it's a core position. My intent is to continue to hold this company. So to wrap up, is Baba stock still a buy after being up 124% this year? Here is the key takeaway. First, the AI hype is partially justified. Triple-digit growth in AI-related cloud revenue is real and transformative, but the market's initial reaction is also factoring in a substantial re-rating for the stock. The second point is on valuation. While the decade's best opportunity at $70 is gone, even after this rally, our updated intrinsic value suggests the stock is still trading close to its fair value, especially when you factor in the cloud and AI potential. My strategy is a hold and the potential trim only if it hits exuberant levels, which I laid out in detail in this video. I'm not selling my core position because the long-term fundamental remains strong. For those who are tempted to take all their gains off the table, watch my video linked there about when to sell a stock. It's the perfect companion to this analysis. What are you doing with Baba? Are you buying more, holding, or finally taking profits? Let me know in the comments below. And if you appreciate this deep dive into the fundamentals and my personal strategy, hit that like button and subscribe for more fundamental value investing analysis. Thanks for watching, and I'll see you in the next video. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.